Welcome to TheoTrade. This is Don Kaufman. November 21st, 2020. Doing the weekend update here on a Saturday morning near all-time highs and an absolute mountain of liquidity risk. You know, this weekend's update is going to differ vastly from what we typically do, which is, really kind of breaking down the markets and what we're looking at in the future. This weekend's update, we're going to talk about, again, a concentration of liquidity risk, and it's possibly the most important thing going on structurally inside of the markets right here and right now. Let's get to work on this weekend's update. One of the things that we hear continuously is about this disconnect, if you will, between the marketplace, and here I have the SPX, but if you're more comfortable, bring up the spiders. The marketplace, which is at or near all-time highs, and specifically, again, this is the spiders, but if we were to bring up another ETF, the QQQ, also sitting right near all-time highs, or we could bring up the Russell, which is, for the most part, pretty much at all-time highs. So the disconnect, of course, between the markets and what's going on, fundamentals in the world, throughout the course of the world, throughout the course of the S&P 500, if you will, because of course, there's a lot going on in the world right now, and I'm going to try to describe what we see in the marketplace and why we're actually seeing this massive disconnect, okay? And really, more or less, we're going to be pointing a finger, if you will, specifically at liquidity risk, and I'm going to explain again what that liquidity risk happens to amount to. So we're going to start with just a few ideas here in the marketplace. Of course, the S&Ps this week, sold off very, very mildly. The volume was, for the most part, kind of unchanged. Not a big differentiation in volatility throughout the course of this week. Volatility relatively flat. The bond market, it rallied. Maybe that's a little bit disconcerting to you. At the exact same time, though, the dollar did much of nothing. So again, I wanted to focus this weekend's update on where I see risk and where I see the disconnect. Let's start with what I term fundamentally flawed. All right, the Treasury just yesterday, announced it ends the emergency lending programs, that has to do, of course, with lending to businesses in need, this predominantly small businesses, mid-sized businesses, and they're literally going to cut off the spigot. The Federal Reserve, so the Treasury obviously is separate from the Federal Reserve, or at least we want to believe that, but the Federal Reserve immediately had a press release that they were disappointed in that. Many of the heads of the Fed responded to it in a very negative light. Nevertheless, they ended the program. It didn't necessarily have a larger impact to the marketplace. A little sell-side activity here in the last hour. But net, if you looked at the entire trading week that we just went through, for me at least, it was a disappointment. I was expecting a lot more volatility than this. We had a little bit of sell-side activity, though, net on the week. And by the way, if you looked at the QQQ and applied its auto-expected moves to it, the Qs actually finished the week massively unchanged. And last but not least, the IWM. The IWM actually finished at the upper edge of its expected move. So net, some really heavy negative news breaks on a Friday. Markets unimpeded. Maybe the markets are looking at this. Well, there's going to be a new head of the Treasury, January 20th of 2021. So maybe they're already looking past it. But we also have renewed economic pressure with all of the lockdowns. Of course, a lot of smaller businesses, once again, are being forced to close, predominantly some of the restaurants, some of the gyms, schools are closing around the U.S. But again, the market looks past this, Unemployment benefits running out. This is a critical one that I think most people are probably aware. But I believe there's about 7.5 million people. Their unemployment benefits are going to end specifically on December 26th. All right, so all of these risks are mounting. Then we actually have the Fed in a speech actually talking about a double dip recession. The risk of that is dramatically on the rise right now. Again, the markets, specifically here, we're looking at the IWM, stare at it, just keep chugging right along. Where and what, okay, is this disconnect? And I believe that we can actually track much of the disconnect specifically to trade concentrating liquidity. Now, traders have been concentrating liquidity for literally, okay, years, decades, if you will, in the marketplace. But never before have we seen such large concentrations of liquidity. And for those of you that are new with some of that terminology, I'm actually going to explain a little bit what is, concentrated liquidity and what are the effects of it, and more appropriately, well, what's it doing to distort the marketplace? And we're going to look at that. So let's actually start to break down what is concentrated liquidity. When people look at liquidity, okay, very often, and I'm actually going to pop in here like the spiders. Okay, so we're going to look at the spiders. The spiders are, hands down, one of the most liquid products in the entire marketplace in terms of, overall volume. If you took a look at like these, the option markets, the shares over here. First of all, though, the shares on Friday, which is a little bit of a slower day, only did like 70 million shares. But let's take a look in terms of overall liquidity, year in and year out. In this particular case, I'm just going to pull up a 15-year weekly, okay? And in this 15-year weekly, one thing that I think is fairly apparent in looking at a much longer time frame is, and this kind of surprises a lot of people, the liquidity is, kind of on its demise, other than, of course, the coronavirus crash, which we spiked up in liquidity on a day-to-day basis. But net liquidity has actually been declining in the SPY shares themselves. Is that true of a lot of other products? Of course, you can have a look around. You're going to find some differentiating factors in here. You look at something like Apple. Apple, interestingly enough, is absolutely on the decline. Okay, but then again, Apple shares are worth 117 right now, which back in the past over here they were worth $25. So maybe you had to trade 3-4 times as many of them. You can make that argument, but even that mathematics wouldn't work out, because here we're actually averaging again over 5 times the liquidity that we've been averaging as of late. Think about that for a second. So the liquidity, even something like Apple over the last 15 years, and this is a weekly, doesn't matter, neither here nor there, has actually declined substantially. Where else do you want to look? I mean, again, you got to have companies that have been around a while. Let's bring up something like Goldman Sachs. Goldman Sachs, again, some of the liquidity peaks out during the financial crisis, to be expected. I mean, Goldman Sachs didn't even pick its head up off the mat much for the corona crash. Okay, down the list of the usual suspects, look at something like Caterpillar, constant liquidity decline inside of here. But I'm going to tell you something. The liquidity that we're actually concerned about, it isn't so much, okay, shares. It's not so much about shares, okay, because I'm going to make the argument right now that the concentration of liquidity, all right, has a lot to do with the options market. And the options market is actually moving, okay, the stock market. It is literally the cart leading that horse around right now. And, well, I'm going to show you. So how can we actually display this? And again, what is this concentration of liquidity? I think the best way to describe a concentration of liquidity is to understand that, for the most part, what it means, everybody's actually driving specifically into a handful of products. Okay. And if you drive capital into a handful of products, you can move those products. Okay. And it wouldn't take that much to move those products. So allow us to look at a product. And in this case, you know what? I'm actually going to jump to a product that everybody knows, everybody loves. Let's look at Tesla. All right, because Tesla had an absolutely wicked week to the upside. And actually, it's Tesla that really sparked my wanting to discuss this concentration of liquidity, because this is just, it's insane. I mean, you start looking at this and you start thinking about, how did this occur over here? This is a gamma squeeze, right? I mean, this is literally what a concentration of liquidity is all about. So if I go over to the trade tab here, specifically on thinkorswim, I'm going to go ahead and I'm going to close up this left side bar for a second. And I'm going to open up down below. It's under option statistics. If you're unfamiliar with it, well, you get familiar with it. All right. So option statistics. By the way, this kind of data is available off the Option Clearing Corp kind of site and so forth. But I figured this was a nice, clean way to describe it. But here, what we're looking at right now is the fact that Tesla traded, okay, approximately 1.1 million option contracts just on Friday. This is just, again, Friday's data. So it trades 1.1. Woohoo! Big whoopee. Actually, interestingly enough, that was extraordinarily light. Okay, what the sizzle index is, the sizzle index is today's option volume, in this case Friday, today's option volume versus the previous 5 trading days option volume. I know that sounds kind of out there, but again, I worked thinkorswim and TD Ameritrade for 15 years, and I was involved in some of this logic. What I really wanted the sizzle index to be was like a 5-day like average, okay, of option volume. And when it says 0.43, basically what it said is, Tesla at 1.1 million contracts was actually trading even less than half of what it had done in the previous 5 trading sessions. It was a really, really light day in Tesla. That's the point I'm trying to make over here. And yet it still traded, 1.1 million contracts. Okay. But then you see it only traded about 33 million shares. If you think about option contracts have to have a hedge. That hedge is unequivocally the stock. So if you trade a few million option contracts, or in this case, even a million option contracts, and remember, one option contract is the equivalency of 100 shares. But you know what? Okay, that's assuming it has like a 1 delta, right? But, in terms of contracts, well, let's say it even had like a point, okay, let's say we had an average of a 0.3 delta being traded, right? So at a 0.3 delta, so for the most part, one contract was the equivalency of like, 30 shares. Okay, just do some quick math over here. Even if it was 30 shares, take a look. We traded a million of them, and then we did 33 million. You have to realize that almost all the volume that's trading in Tesla in terms of the shares is being generated by the option contracts. It's the hedge. Okay, and most people don't really understand the concept of what do you mean the hedge? Okay, what's the hedge? That's how market makers actually deal with risk. And market makers want to lay off this risk, but if you look at 1.1 million contracts being traded and the average contract, okay, is approximately a 30 delta, then you would need this kind of volume just to substantiate, okay, and cool off some of the risk of somebody trading, 1.1 million contracts. That's just the bottom line with something like that. So for the most part, okay, without question, you have the cart leading the horse in here. Inside of in Tesla. Look at the number of calls trading versus puts, which is also, it's not abnormal that almost double the number of calls trade, which is, again, why you get these huge squeezes. And now people actually ask, well, so how can you move the stock? All right, well, I'm going to explain that a little bit. And again, this all leads to concentration risk. So how do you, at home, move Tesla stock? Okay, you're going to run out and you're going to buy, okay, calls. You're going to buy calls. And in buying calls, what call are you going to buy? Let's just come up with a number in here. Let's say you're going to buy calls and you're going to buy, okay, the 500 strike call option. So you're going to buy that call option. It does not matter, okay, what it's trading for. It's probably going to have, and it's about a week out because we're trading here at 498. It's probably going to have about, okay, a 0.4 delta associated with it. What that basically means is you're getting, 40 cents bang for your buck for every dollar move inside of Tesla, yada, yada, yada. But you're getting basically 40 deltas. Now, when you go out there and buy calls, okay, you are actually buying yourself into a positive delta position, okay? So you're buying positive delta. So if you're buying positive delta, let me ask you something. Who sold you those 500 calls? A market-making firm. Citadel did it, man. Okay, so then you have a market-making firm. We're going to call the market-making firm down here Market Maker. Okay, they're having to sell you those 500 calls. And in selling you those calls, okay, you are positive delta. They, okay, then would be negative delta. But do you think a market-making firm actually wants to take negative delta risk? No! So what happens is you gave them negative delta risk. Naughty! And for every, one contract that you bought, okay, you made them the equivalency of short 40 shares. So how do they actually, resolve the fact that they're short the equivalency of 40 shares? They turn around and they buy, okay, 40 shares. And as the stock actually moves higher or lower, they will dynamically hedge that risk of those 500 calls. But immediately you have to realize that your purchase of a call option, okay, caused them to have to, sell calls. But if they're selling calls, then they're actually doing what? Buying stock. And when they're buying stock, they're actually forcing, okay, the marketplace to move. So literally, okay, you think, you're out there and I'm a buyer of these 500 calls and I can't do anything because I'm just, I'm sitting at home between my Pentium and this computer, and how can I move the markets? Because your purchase of the 500 calls actually sparked, okay, a little bit of a reaction because they actually sold you those 500 calls, okay, which turn around and they have to then buy stock. And that stock they're actually buying can actually force it to the upside. The more option contracts you trade, okay, the more we actually get concentration of liquidity risk and can actually move different products in the marketplace. Now, before I even go any further, I'm going to show you some really crazy stuff here in a moment. You have to actually realize that you can rock the boat with this. Okay, what rock the boat basically means is the same way this works to the upside, it also works to the downside. And that's why I call it, yeah, we're near all-time highs, but there's a mountain of liquidity risk. And, if you're actually, asking why their market has a disconnect, I'm going to show you why the market has a disconnect right now. All we have to understand at this point, your purchase of calls, okay, you at home, okay, your retail, you're sparking algorithms then to sell you those calls. And then those algorithms go out and they will actually buy stock and force markets higher. It doesn't matter what the fundamentals happen to be. And that's why I thought this was called like fundamentally flawed, because nobody gives a crap. If you turn around and buy calls, you're actually going to force markets higher. Now, why is this kind of interesting? Here we go. What you're looking at right now is a slide. Okay. On this slide, it's the option, okay, clearing corp, the OCC, and it's total option and futures contracts. And by the way, those futures contracts, okay, this is not the futures contracts that you're thinking. This is futures contracts that actually clear through the OCC. So it's vastly different. Nevertheless, if you take a quick glance at this, all I want you to see is that close to 37 million, okay, option contracts traded. About 37 million option contracts traded total, okay, in the marketplace, specifically on Friday. That's it. You don't have to elect the exchange designation. You're like, oh, that's so very exciting. This is just totals. That's the one I threw up here. You don't have to worry about the exchanges and so forth. I just think that that's, a little ancillary. But anyway, about 37 million contracts had traded hands, and I'm just rounding obviously to the nearest millionth in this case. So what? So 37 million contracts traded. Okay, where am I going with this? Well, right off the bat, you have to realize, okay, what I was saying a moment ago in Tesla. Okay, Tesla was already a million of those. So you already have Tesla, one product in the entire vast array of the marketplace that's trading 1/37th of the overall volume. Right? That's just one product. Okay, so one product, Tesla. Okay, you're like, Tesla can't move markets. Tesla can move markets. All right, because it's also, if you start thinking about Tesla in terms of its like notional value, Tesla's a $500 product. Okay, it's a big boy product. So Tesla's options, okay, if you look at Tesla being a $500 product, you look at Apple being a $117 product, Apple also traded, okay, about 1.1 million contracts. But who traded more notional value? Notional value means if you took the contract, okay, and actually calculated how much capital it's moving, like how much, real value is in there, all right? You have Tesla being what? Okay, 4 or 5 times larger. Apple's a $117 stock, and Tesla happens to be none other than almost a $500 stock, so it's approximately, we'll call it 4 times larger. So there's actually 4 times more, capital really flowing through Tesla, right? So now all of a sudden you're like, oh, I kind of get what you're saying over here. We're not done yet. So 37 million option contracts trade. Okay. First of all, this is actually data, okay, taken also from the Option Clearing Corp. Specifically, this one's actually taken from the Chicago Board Options Exchange, the SIBO site. And if you take a quick glance, this is also from Friday. The first thing you're looking at is the most active ETF options. Okay, so ETFs, what are your ETFs out there? Because again, we want to talk about like overall liquidity. So let's look at some of the ETF products. All right, the spiders. Okay, so the spiders are unquestionably, okay. And by the way, I rounded this. This is about 4 million contracts. It's really, 3.95. Okay, the QQQ, which traded what? A cool basically million. IWM is on this radar screen. The point that I'm trying to make with this, in the terms of the big ETFs, I only counted 1, 2, 3, 4, 5. 5 of the biggest ETFs already traded 6.4 million contracts. Remember, net, we only had 37 million contracts total that traded, okay? Just these ETFs, just the top 5. I could have kept going, all right? These just traded 6.4 million. So you're like, so what? Okay, so what? It's 1/6 of the volume. You realize I could have kept going down the list. It would have really added up quite quickly. like about how much volume is actually being traded just in the ETF contracts, specifically like the spiders. And what are the spiders just like? They're like the SPX. In fact, okay, let's move on. Now we actually go to the most active index options, okay? The SPX, the mother of all products, the SPX and the VIX, okay? SPX, VIX, the Russell, okay? The XAU, you know, like these products don't even trade. The only thing that really matters on this screen, okay, really the only thing that matters on this screen, the SPX and the VIX. I mean, the Russell's only 41,000 contracts. Who cares? But between, okay, the SPX and the VIX, they're good for another 1.5. But here's the crazy thing, okay? The SPX is a monster, which I'm going to make a point in a moment. Then people, we come over to the most active equity options: Apple, Tesla, NEO, Baba, Snap. Yeah, they're good for 4.6 million contracts. Net, what do you have? Over 1/3, or over 12.5. Over 12.5, okay, million option contracts of 37 million option contracts traded in a handful of products. By the way, the SPX notional value exceeds other products by a multiple of at least 10, probably 20, meaning that if you took a look at the SPX, which again I call the mother of all products, it's one of the reasons we look at it so incessantly here. But if you did take a look at the SPX and you bring up its volume, it traded a million contracts. But again, it's a $3,500 product, which is, you know, how much bigger is that than something like Apple? You know, Apple may have done a million contracts or 1.1 million contracts, and the SPX also did 1.1 million contracts. But what's worth more? I mean, the SPX is what? Yeah, 30 times the size. It's literally like 30 times the size of like something like Apple. I just threw out at 10 times the size. The point that I'm trying to make, okay, with all of this is that basically what you have is not just a concentration of liquidity. People, everything right now, everything is being forced into the SPX, okay? The SPX, if you can move the SPX, obviously you can drive the marketplace. But with the SPX, okay, the spiders. What's the difference between the SPX and the spiders? Well, one is an ETF, okay? One's an ETF. But other than that, they're basically the same product. So all of a sudden, just between the SPX and the spiders, you already have over 5 million of that 37 million contracts. And the SPX is a magnitude of at least 10, maybe 20 times the size of all other products, okay? You think about this in terms of overall liquidity, it is jaw-dropping, okay? No one is trading anything, okay, but a handful of products right now. That's it. Look, this is the top 5 products. And by the time you get down to Snapchat here, it already drops to 400,000 contracts. They're trading Apple, they're trading Tesla, they're trading NEO, maybe a little Baba, right? The SPX they're trading, the spiders they're trading. Okay, that's it. I mean, you can actually account for most of the liquidity in the entire marketplace right now is to what? Is less than 10 different products. And those 10 products are capable of moving the entire marketplace. If you're looking for your disconnect, you just found it. It's just a mountain of liquidity risk. But then we actually come into this idea of kind of rocking the boat. And right now, okay, right now, if you look at the marketplace, it's pretty evident. Right? When the market starts to go up, what's going on is people are actually buying things like call options. You buy a call option, it actually sparks what? The market making firm to sell the call option to you. And then the market making firm has to go out and either buy shares of the spiders or buy S&P futures contracts to actually drive markets higher. Why are they driving markets higher? To mitigate their directional exposure. If, okay, you're on a boat and you yell to everybody, okay, you know, port side, and everybody obviously runs to the port side, the boat, you know, flips to one side, you know, run to the other side. Literally, that's what we're seeing inside of the marketplace right now. And for the most part, okay, this is a wildly, and it really is, retail-driven marketplace with the professionals ultimately reacting to that. You have to keep this in mind because, okay, in effect, with the good kind of comes the bad. In a fundamentally flawed environment, if retail starts to really change, okay, the way they feel about the marketplace, what's not to say that they start learning a little bit about puts and start trading the put side of the marketplace and ultimately driving markets a little bit lower. Okay, we are on the edge, people. When you see a liquidity, concentration like this, I would actually refer to it as a liquidity crisis. You got big problems in this marketplace. It is structurally flawed right now, okay? From the standpoint, forget about the fundamentals because there just aren't any. I mean, you don't have to go much further than to look at products like Caterpillar, right, to realize that, you know, going into a double-dip recession and a company like Caterpillar, you know, rocketing to the upside, or look at some of the airline stocks, okay? Again, markets right now, they don't really have a driver. That cart is leading that horse around. listen, this next week we're coming into a holiday week of trade. The expected move is down, okay, to 67.39 in the SPX. But I'm going to caution you, okay, with everything going on, okay, in the marketplace, in the world, that you can still very easily see substantial moves. Why? Okay, and one of the things that we've been covering kind of week in and week out is how we keep breaching things like expected moves. And you're like, how can the marketplace be so wrong? And what I'm talking about is when you start to look at stuff like IWM, it starts cracking the low side of the expected move over here, right? Then it cracks the upside of the expected move, cracks the upside of the expected move, hits it up here again. I mean, just week in and week out, okay, the marketplace is getting it wrong. That's because retail is actually running the show right now. And with retail running the show, it's dangerous. And in any given week, even if we were coming into a holiday trading week, we have 3.5 sessions. We have a full day Monday, a full day Tuesday, a full day Wednesday, close for Thanksgiving on Thursday, and a half a trading session on Friday. Okay? Give the market room to move because, again, volatility, it's right around the corner. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.